Good morning, everybody. Hope you're having a good day. Hope you had a good summer. Hope you're enjoying the Indian summer a little bit while we still have it. Now, this morning, this presentation to you in a minute, I'll share my screen with you. We're going to go through what we call a 3x5 presentation. This has 3 sections for you, and then 5 charts in each. These charts are on a different topic related to markets, business, the economy. They go back varying degrees of time. And the reason we do this is that in the business and the economic business and business of business, we find that while history doesn't repeat, it rhymes a lot. And today markets are moving a little bit. There's some selling in stocks, some selling in bonds today, not to an extreme. We know this has been a volatile year. We know this has been a year of things that have happened that we didn't expect. We didn't expect Russia invading Ukraine. We didn't expect China still being locked down in many regions of that country and still talking about it today. That's affected global supply chains. We did expect central banks to be active this year, but now there's a debate about those, which we'll talk about with you in a minute. So kind of that precursor, we should be done in 40 minutes, then to be able to get things to you. So if you can ask questions, if you want to ask questions this morning. The title of this presentation is, yes, no doubt, we have had a storm in markets this summer, not so much in business. We hope your business hasn't felt it. But we've had a storm in markets. We've had a storm in markets we haven't seen since the 1980s. And unfortunately, it's somewhat analogous to what a lot of our friends and family, neighbors and colleagues are feeling down in Southwest Florida right now. What do? Well, you clean up, you plan, you rebuild or repair. And it's not much different in markets after we've had a market storm, stocks, bonds, commodities, currencies, this summer. Now, this first chart for you, if you're not familiar with Huntington, this is Huntington's retail footprint, these green states. So Huntington has been growing. Huntington will continue to grow. The latest area we've opened is out in the state of Colorado, up and down I-25. And we look forward to welcoming those colleagues. So Huntington itself is out of Columbus. Kind of I'm on the upper right, or excuse me, upper left. What we're talking about, what we represent, my colleague Steve DeArmond is with me on the call today. We're a $26 billion investment shop, as Megan talked about. And we're organized just like you would see Wall Street organized. We have an economic team, equity team, fixed income team, etc. And that's where a lot of this information comes to you today. That's where a lot comes from today. So we'll get going here this morning. Remember, things on your mind as we go through this. The first section, remember there are 3 sections, is talking about not only the US economy, but we need to talk about the global economy a little bit. Our businesses may be domestic, but there are some things going on in the global economy we thought you'd appreciate knowing about. And at this point, we would say, and we're with consensus on this at Huntington, we would say, as you can see in black here, there's a 50-50 chance of recession next year. And a lot of it will have to do with economic items that we talk about with you in a minute. And then another whole section of it will have to do with what central banks do. Because they're getting very aggressive. They're in the news. They're in the news as we speak, actually. So we'll talk about that with you. So 5 slides here, this section. We thought you might like this. So this is what the global economy looks like if you've never seen this before. This is what we call the $1 trillion club, these countries down at the bottom. Each one of these countries has economic output over $1 trillion. And the club keeps growing. Indonesia was the last one. Indonesia and the Netherlands were last ones to join it. So if you do business overseas, This is how the global economy lays out. So we want to make a couple of observations for you here. First off, most of this information comes from the IMF, International Monetary Fund. They actually updated these numbers this morning. We haven't had a chance to incorporate it, but I can tell you, if you look at the upper right, you see their estimate for global growth next year at 2.9. They took that down to 2.6, I believe, this morning. So these numbers, these projections are changing a little bit. IMF is probably where most of this is sourced from. If you ever need a good question or trivia for a cocktail party, look in the upper left. Global GDP is $96 trillion. And now, let me back up one second. When you hear the term GDP, stands for gross domestic product, think of GDP as revenue of a country, not revenue of a company, but revenue of a country. And if you look at the left side, the US still has more revenue than anybody else. We're a $23 trillion economy. Nobody's close. China's second, as you can see there, with 17 trillion. Then it scatters through Europe. If you take all of the Eurozone together, they're about 14 trillion. So the US is still king as far as global economies go. Probably will be for some time. What then to notice is down at towards the bottom, you see some percentages. One of the reasons we put this in here is these percentages represent what the IMF, International Monetary Fund, what they believe or project their economies will grow next year. So you can see in the US it's 1%, then it works down all the way to the Netherlands at 2%. Now, the reason we show this to you is, again, these have been updated this morning. They're probably, this set comes from the month of June. It's probably optimistic because they only project, they being the IMF, one recession next year. You see some red arrows at the bottom middle, and that's Russia for obvious reasons. There's probably going to be more recessions next year, really starting in Europe. Here in the US, again, we say it's 50-50. But we thought you'd appreciate seeing this, just the layout or the landscape, whatever word you choose, of what the global economy looks like. US is still top. Now, here's an issue. Global central banks. If you look where that dashed black arrow is, they're all raising rates right now. Problem is they're raising rates so fast to overcome inflation. We all feel inflation. We know it's here. We're paying more for everything. But is this rate rising too far, too fast? Because when a central bank raises rates, it takes a while to get it through an economy. It's 6, 9, 12 months before it gets through an economy, the increased interest rates. So the argument right now is, and by the way, the IMF is talking about the same thing, should these central banks calm down, see what all the increases in rates this year do to the economy next year? That's the area of focus. And will inflation now come down on its own? So there's a huge degree of debate. Central banks, their campaigns this year to raise rates, slow economies down, because we each have a view of that, what it will do to the economy next year, and then will it even bring inflation down? We're in a supply-constrained economy. Will it bring inflation down? So there are a lot of debate points. This is a great time for this. We're going to give you some other things to think about, obviously. Number one is central banks. Now, this one coming into the Fed, this is kind of a technical chart for you. We're kind of going to go through this quick, but our central bank is actually tightening policy in two ways. It's in the black box up above. They're not only raising their benchmark interest rate, which each of us have a view of. If we're borrowers, we don't like it. If we're savers, we might kind of like it. So they're raising rates, number one. But number two, they also have a huge balance sheet where they've been buying treasuries that they're now bringing lower. Now, the term when they were buying treasuries was called quantitative easing, QE. Now that they're shedding treasuries, the term has shifted. It's QT, quantitative tightening. So in other words, they're taking money out of the economy. So are these dual methods too much, too fast? That's the debate. Our Federal Reserve meets next on November 2nd, and it's going to be a continued debate. Just pointing it out to you. The red stars here are where the Fed itself says they're going to take short-term interest rates up above 4%. They're going to take them close to 5% next year, they say. And they're going to take that balance sheet down noticeably, $95 billion a month. Those two actions are going to affect our economy. They're going to slow things down in the economy. We've already seen it in the housing market. Now, here's this next part. Here, we wanted to actually detail for you where our 50-50 comes from with respect to chances for a recession next year. Here are two charts, 25% each, why we might get a recession next year. History suggests we do with these two charts. Number one at the top is something called a leading economic index, comes out every month. We'll get an update next week, actually. This chart goes back, you can see, to 1959. See all those light blue columns within this chart? Those are all the recessions our economy's been through since 1959. Well, a good indicator is when this index has 10 items in it. When it goes negative year over year, like it is right now, that's a pretty good indicator since the 50s that we're going to go in recession after this, sometime after this. So that's reason number one. And again, we get an update next month, or excuse me, next week. Reason number two, and we're going to show you another version of this in a minute for your business, is inventories. Think about your business here. Classically, what a recession represents, by the way, is 6 months, 6 consecutive months of lower GDP, or think of it in our company terms, lower revenues, lower sales. That's what a recession is, 6 months of lower GDP, 6 consecutive months. Now, classically, a recession has involved inventories rising. I have to shut off my production line till I can clear out the inventory that I have in storage. So that's the bottom chart here. And we've seen inventories rise noticeably, not just cars looking for semiconductors parked in parking lots around us, but all kinds of things. This actually started with retailers. This is going to be a really interesting holiday season for retailers. So these two charts, by their history, would argue for a recession next year. All right, here's the counter. Here's two charts that represent no recession next year. So 25% each. Top one, employment. We've actually had one recession in the past 50 years with employment growing. And we found out last Friday, employment's still growing. And by the way, that one recession, if you look on the left-hand side of this chart, you see a green box there and a green arrow. That was in 1974. It's the only time we've had a recession when employment is still growing. So it's rare, it's doable, but it's very rare that we would have a recession next year, given that employment is still growing. And we're all still searching for workers. All right, second chart. Down at the bottom here is something called ISM indexes. Now think about your business. There's one for services, there's one for manufacturing. A reading above 50 means growth. What these indexes are surveys of purchasing managers saying, hey, in this case, how do new orders look over the next 6 to 12 months? Well, for services, which is the dominant part of our economy, right or wrong, we each have a view of that. For services, the reading is 60, means growth. New orders are growing over the next 6 to 12 months. That would argue against a recession. That's where we get 50-50. The Fed probably is going to be the arbitrator. How high they take rates, how restrictive they are around monetary policy. So this is the way it's developing right now. We'll obviously be following these in the next year. These come out, each one of these reports we just showed you, these 4 charts, come out monthly. All right, let's talk about business. Now, this presentation to you is not about monetizing my business. We have all kinds of resources at Huntington for that. As a matter of fact, we've acquired more. If you're looking to monetize your business, Steve DeYarman would be your contact there. For business, here's what we're looking at, and they're related to these past slides. They just look different. 4 things we're talking about here. We're going to throw in a 5th for you if you do business globally. So again, in this section, think about your business. Number 1, every month, the NFIB, National Federation of Independent Business, does a survey, about 6,500 members. In this one, they ask the question, what's your single biggest problem? The categories are down the right-hand side. Yeah, inflation's number 1, no doubt. Totally agree. But look what's toward the bottom, poor sales. Now we put a dashed arrow in here in the middle of this chart coming out of the Great Recession in 08-09. Obviously, poor sales was the top. That was the biggest problem. Now it's near the bottom. So our recommendation for you here, what we've been talking about with our business clients since the spring, look at your forward order books. Is there a consistency to orders? Is there a duplication? We had a lot of manufacturers with duplicated orders as everybody was running to fill up supply chains. So right now it's not a problem, but next year, as you're probably already doing, make sure you're looking at your forward order books. Here's the second item. This is just a little bit of a different way to look at inventories. This chart only goes back 20 years, but basically business inventories are up 18% from a year ago. That's big. Hopefully you're not in the same position. Small businesses, through another question in that NFIB survey, which is monthly, most small businesses, the blue line here, do not plan on increasing inventories, obviously. So the second thing on your checklist for your business would be look at your inventories. Are they where you want them to be? Too high, too low? How are you going to adjust it? Third item. Now this is a nasty looking chart, but we show it to you with a purpose. This is productivity. This chart actually goes back to World War II. So again, all those light blue columns there, all the recessions our economy's been through since World War II. Well, the reason we show this is something happened in the first half of this year that hasn't happened since 1947. Productivity went way down by the most since 1947. So remember, this is a national number. When we talk to our business customers about this, and you, who probably have a different view, but what happened in the first quarter in our country was GDP, revenue went down, but employment went up. That's where this negative number comes from. So where we bring it up to you today, though, is that we know starting wages have doubled over the last 3-4 years. Make sure you're thinking about productivity as wages have gone up. It's okay to pay people more as long as productivity goes up. So pay attention to that, because nationally we're struggling the most since 1947. Here's the fourth item. Bet you didn't know there was a global supply chain index. Well, yes, there is. It's put together by the New York Fed. It's called a Global Supply Chain Pressures Index. You can see it here. It's only been around since 1997. The higher the number, the more pressures there are in global supply chains. Why do we bring this up? Well, look at the top in the green, China. We did not anticipate many, let's say, factions of China's economy would still be shut down right now, which is where a lot of global supply chains begin. So we're all searching in one way or another for something. We're all supply constrained by something. That's what our business customers keep telling us. Now, the good news is this supply chain pressure index is coming down. It's off the peak from, let's say, a year ago. The bad news is it's still elevated. So there's probably something in our business that we're still supply constrained under, starting with employees working out to some piece widget that fits into our product. So just pointing it out that the trend here is good. It's still elevated. We still need to consider it. Now here's the fifth item. If you do business internationally, this is the US dollar index. We came off the gold standard in late 1971. This chart goes back to 1971. This is an index of the US versus other currencies. You can see right now we're on our third period where this index is rising noticeably. Why? Because the rest of the world's nervous. Nervous about what's going on in Europe, nervous about what's going on in China. When the world gets nervous, money often flows to the US. Dollar goes up. Think of a currency as a stock price of a country. When the currency value goes up, people want to be in that country doing business. Right now, money wants to be in the US because we seem to be handling the great lockdown and the great reopening the best. And we don't have the energy issues Europe has. And we don't have the supply chain or still virus issues that China has. Now, if you export, you don't like a high dollar. Crimps profits. If you import, you kind of like it a little bit. So each one of us may have a view of this, but our point to you here is, if you do export, don't give up profits. You can lock this in. We have a capital markets division here, most financial institutions do, that can help you hedge currency risk. Again, this is our third time. Going back to the 70s, we've seen a spike in the dollar. All right, hope this is helpful to y'all. Here's our third section. Now, this is markets, so we're going to change gears now a little bit. So kind of take off your business hat a little bit, put on your personal hat, or your foundation and endowment hat for boards you may sit on. And as mentioned, we know that we've seen a storm in markets this summer. We've had things happen that we didn't anticipate. Russia, China, and now inflation not coming down. But here's some views now of markets, and here's some things that we're thinking about. The first ones we understand. This is a nasty looking chart, but the point here is, if you look at the right-hand side, something called BB Ag, that's bonds. Think of your bond funds. The S&P 500 stocks. This is the first time we've seen both of these down for consecutive quarters since the early 1980s. That's that green section over there on the left-hand side. Now, there's a reason, though, that in the 80s, I wanted to stay invested because the rest of the 80s was very profitable to be invested. Those lines jumped up. So that's number one. Number two, we understand that we've been in a market storm. We've been going through a checklist with our investment customers really since the spring. Do you have enough cash? Do you have conviction? Is your time horizon changed? Do you have the patience to get through this? So we're giving you a visual of something you understand. It's tough to open statements. And by the way, it was a tough third quarter. Now, as for stocks, here's an interesting one for you. Stocks are actually in the middle of a trend. This is the S&P 500 going back to its beginnings in the 1920s. By the way, again, those light blue bars, those are all the recessions. You can see, by the way, on the far left-hand side of this, the depression, how long it lasted. Well, look at this. This is called a trend channel chart in our business. Stocks are just in the middle of a trend. They're not at the upside. They're not at the downside. They're in the middle of a trend. Given that we've seen a double bottom in stocks now, we'd be nibbling here at stocks. We'd be nibbling. All the bad news is in. Stocks are starting to think about the second half of next year now. So we'd be nibbling at stocks. We certainly wouldn't be selling them now unless they're not doing what they're supposed to. That's where you do an inventory of your investments. But for this chart, this tells us nibble at stocks. They're just in the middle of a channel. It's volatile, but in the middle. Now this one's a little bit different. This is interest rates. Lots of information for you. But if you look at the right-hand side, this is what I can get the green line if I loan my money to the US government for 2 years. Here it's 4.3%. As we speak, it's 4.27. That's pretty good yield. We haven't seen that since 2007. The red line is what I get if I loan my money to the US government for 10 years. 3.88% here, 3.93% as we speak. The black line there, that's that Fed funds rate. It's going up again probably on November 2nd. We just don't know about how much. The point here is I can buy some bonds now with the expectation that inflation comes down next year. That's the expectation by the Fed, by private sector economists, by the IMF, that inflation does come down next year. I can buy some bonds here, but I keep it pretty short. So we've been nibbling at stocks. We've been buying some bonds. Not a lot, but buying some bonds. We haven't been able to do this since 2007. These are commodities. If you hear a term called the commodity index, it actually has 6 different sectors in it. The sectors are listed down the right-hand side of this chart. Most of them have been coming lower. If you're a user of commodities in your business, hopefully you've been seeing this. The one that's in focus is the one that won't come down, energy, for various reasons. Up to the fact that OPEC cut production last week. So the red line there, energy's still higher. Crude oil went up 16% alone last week. But a lot of commodities, other commodities are starting to come down now. Hopefully, that's relieving some pressure on your business if you're a heavy user of commodities. Crude oil probably is not going to come down too much anytime soon. We'll talk about that in a minute. But we just wanted to give you this view of commodities because they were in the news so much earlier this year with that Russian invasion of Ukraine, because Russia was basically a commodity superstore. It's what they were. It's what they produce is commodities. And they got knocked offline. But now there's some pressure coming off commodity prices, except oil. All right, this is the last slide. Now we're going to have time for questions, so think about what's on your mind. Here are now things as we move into the new year. So when we asked our teams what's on your mind, here are 5 areas. First off, inflation. We get inflation updates tomorrow on producer prices. That's heavily skewed by commodities. Then on Thursday, we get consumer prices. The narrative is switched in the inflation world. Headline inflation probably peaked in June. The version of inflation that we often argue with is called core. That's the one that excludes food and energy, but central banks pay attention to it. That's what they'll be focused on. So we'll get an update this week on inflation because we all know it's here. Everything's more expensive. Second thing, the world's going to keep searching for energy. We all want to be green. We all know that. But it takes time to do that. These are different areas of fossil fuel markets that are still going up. The world's still in demand. Europe's a mess over it right now because they came to rely too much on Russian natural gas, which is being cut off now. So the world's going to search for energy. We're probably going to see energy prices higher longer as we try to transition to green. Third item, central banks taking rates up, good for savers, bad for borrowers. We have to start think about our borrowing decisions now. Then housing market is a residual of this, by the way. It's better for home buyers than home sellers now. That's shifted as short-term interest rates have gone up. Again, next Fed meeting is on November 2nd. The important one, though, actually, the one to watch now is called the ECB, European Central Bank. They actually meet before the Fed on October 27th. They're the one to watch now because they've been going up 0.75% at each of their previous meetings, just like the Fed. Will they change that? That's what will catch the attention of markets, October 27th. This one's a little bit more specialized, number 4, but reshoring we know is a theme. You hear a lot about the semiconductor business here in the US, bringing that back to the US. You'll be hearing more about other reshoring items. It kind of came through the healthcare arena a couple years ago. So reshoring is going to continue to be a theme. And then something that happened this year, trade routes. If you are in the global business, trade routes are probably going to be more north-south now than east-west. This has to do with what's going on primarily in Europe and Asia. The trade routes are going more north-south now than east-west. That only may pertain to a percentage of us. The 5th one, though, is interesting. Here's where we'll end it. Who's going to have some economic growth strategies? Now, here's what we mean by this. Fiscal policy, you see the first line item there. In our country, that's Congress, so that's tax and spend. Well, yeah, we've had spending, but it's been targeted. Now more of the rhetoric is on, and more of the programs, more of the focus is on raising taxes to pay for the stimulus from a couple years ago. By the way, we're not the only country doing that. All countries are doing that. We have an election coming up in 3 weeks where if history repeats, or even looks like, Congress is going to flip control. It's usually what happens in midterms. We don't know. It's a toss-up in our view. But fiscal policy is probably going to stay tight. It's going to be more focused on taxes and spending. Well, the other policy is monetary policy. That's the venue of central banks. Well, what we know is they're taking monetary policy support away. They're raising rates. If they were buying bonds, they're not doing it anymore. So where will some growth policies come from next year? That's very much on our mind. Who will support growth policies in their country? By the way, China's doing it to some extent, but they're still closed down or locked down. The UK started doing it where they cut tax rates, but their bond market had a conniption over it, and they had to back off a little bit. So in our world, really, the only growth programs we see are coming out of China and the UK right now. That's something on our mind for next year. So I hope this was helpful to you. Hope this gave you something to think about in your mind for your business, for your personal circumstance. I'm going to stop sharing now the screen. Megan, I don't know if I turn it back over to you, or Angie, if I turn it to you for questions, but thank you very much for having us today. Angie, I see you're up. I'll turn it back to you.
Yeah, thank you, John. I thought this information was fascinating, and your charts are great. A lot to think about. And we did have a couple questions come through. Historically, inflation has only been brought under control when interest rates rise to the level of inflation. What makes that different this time around?
Well, this inflation is a little bit different this time around because it's so supply constrained coming out of a lockdown. We've never had a global lockdown before. We've never had supply chains disrupted like this because of the lockdown. So you're exactly right. So the point here is that inflation is running 8%. Historically, the way central banks got on top of that was they took their benchmark rate up more than 8%, to higher than 8%. This time they're not doing it because this time it is a little bit different. We've never been through a lockdown. We've never been through a reopening. We've never been through supply constraints like this. So that's why this is a challenge for central banks, and it's going to be with us in the next year. So hopefully that helps.
Great. Do you know the average real GDP growth estimate as a comparison point for the 2.9 or 2.6 predicted for 2023?
Well, you bring up an interesting point. Whoever asked this. We didn't cover it today, but the Fed did something fascinating at their September 21st meeting. So every quarter they come out with their own economic projections. What they said, now just remember these numbers. What they said at their September economic projections, they said the economy is only going to grow 0.2% this year, but it's going to speed up to 1.2% next year. Well, that goes completely against what consensus economists and what the IMF thinks. Just to give you an example, here's what consensus economists think. And these are the closest we can come to. These are all real, by the way, real GDP numbers. Consensus economists think the economy is going to grow 1.6% this year. 1.6. Remember, the Fed's at 0.2. Then the consensus of economists thinks the economy slows to 0.7 next year. Fed thinks it speeds up to 1.2. I've been doing this 30 years. I've never seen the Fed go against consensus economists like this. I hope they're right. I hope the economy does accelerate. So to answer your question, you kind of think of the Fed as the chief economist of the country. Well, they're going against what all the 70 economists surveyed by a news organization called Bloomberg every month are saying. They're actually going against what the IMF thinks now in their projections, because they think we're going to slow down next year. So there are different sets of consensus numbers, and they are not in agreement right now. So next year is going to be really interesting. That's why we say watch those factors for your business.
Can you touch on how the Intel investment in Mid-Ohio will affect our local economy?
It's probably going to affect the regional economy as well. It's probably not only going to affect us in Northwest Ohio. One of the, let's say, one of the areas of discussion for what's called Silicon Heartland in Columbus is not only is it about Ohio, it's about the Big Ten. So it's about, one of the things it's about is when I graduate from a Big Ten school now, I have a place to go in the Great Lakes to start my career in technology. That's big. So this is a pretty broad project, obviously. It's a $20 billion project in Central Ohio. There are already suppliers from Northeast Ohio, from Pittsburgh, talking about how they can supply, obviously, into this project, which is going to be huge. I'm sure there are in Northwest Ohio. We haven't heard about them yet, but I'm sure we will. Up in Michigan, we know there are companies forming to feed into this Silicon Heartland as well. So this is going to be a big deal, not only for suppliers, but hopefully, that kind of the brain drain ends in the Great Lakes region. The college graduates stay here now. They don't have to move to the coasts anymore. They can stay here. So this is a multifaceted project. We hope it's successful.
Yeah, so along those lines, I had a question. Who benefits from the reshoring? I assume what part of the country benefits from the reshoring?
Yeah, I mean, it's going to be business by business. Healthcare should, number one, workers should, because these are generally higher paying jobs. They're generally related to manufacturing, semiconductors, healthcare. So it's going to be more or less headline by headline, something that's determined to be at risk or in low supply because of where it comes from, where it's made in the world, and should we make it here? So this started with obviously crude oil several years ago. It's going to spread into other industries, into other businesses. It'll probably still develop. There are things that'll be, let's say, queued up for reshoring that we don't even know about yet. That's good. We would say that's good for the U.S. economy.
Okay. Do you see, with everything still happening in China, do you see more in addition to reshoring, more work coming to Mexico or Canada?
Yep, that's where that north-south comes from. So as China now slows or let's say opens up hesitantly, let me back up. What companies are realizing, many of you may realize, is what actually started in Japan in 2011 with that tsunami. What a lot of companies realized was they only had one supplier for a widget that went in their product, and it came out of Japan, and that plant is underwater now, or it's closed down because it can't get power. So companies first began rearranging, let's say, supply chains out of that. That was 2011. That process is going to accelerate now out of the great lockdown. Who's been able to reopen, who hasn't? And do I need, in the interest of safety or in the interest of national security, need to think about rearranging my supply chains again? Yeah, probably Canada and Mexico are going to be beneficiaries of that, feeding into the US.
I think that was all the questions I had. I don't know if anyone else had any other questions they wanted to unmute and ask. No? Okay. Well, with that, thank you so much, John. We really appreciate you being here this morning. As Megan said, we did record this and we will put it on our YouTube page and share it through social media. Again, I thought the content was fabulous. A lot of good things to think about. In your opinion, overall, is the outlook good for us, the U.S. in the next year?
It is. We got to get through this storm. We got to get through next year, get inflation calmed down. Then yes, the outlook is good for America. The outlook's good for the Great Lakes now. Good news. So Angie, thanks so much for having us.
Okay. All right. And thank you everyone for joining us.